That additional profit is not just nice to have, but it is essential for a thriving, profitable tour business. Hi there, Kelsey Toner here, the founder of Guest Focused Tour Business Coaching, where every day myself and our team of tour and activity business coaches are helping you build a thriving, profitable tour business. Welcome back to our series on how to price tours, activities, and experiences for profit. In this video, we're going to be looking at 8 costly mistakes that many tour operators make with their pricing. The idea here is let's go through this list one at a time and let's see and do our best to make sure that you're not making similar mistakes that can be silently draining your profits day after day, month after month, and year after year. Let's dive in. Mistake number 1, copying competitor pricing. This is the most common way that tour and activity business owners set their pricing. We got them look out, do a quick Google search, start looking at who is offering what, and we often feel hemmed in by what others are charging. Like that might be a ceiling, or that gives us a sense of what we should be charging. But here's why this is a potentially very costly mistake without knowing your own costs to operate those experiences. Well, for starters, it's what you don't know about those competitors that is actually the most dangerous. We don't know their fixed or operating costs. We don't know if they own or lease vehicles, equipments. We don't know if they have investors or financial backing. We don't know what they're paying their guides or their staff. And we don't know, most importantly, if they're actually profitable. Now, we're not saying competitor pricing isn't a factor, but just because a price exists in the marketplace does not mean it's profitable. Especially after working with lots and lots of operators in this space, we know for small and medium-sized businesses how tight those margins are, how many people are struggling to pay themselves a livable wage or have healthy profit margins. So copying competitors' pricing could be setting you up for failure. Mistake number 2 is not paying yourself first. And I know this is a mistake that hits home for a lot of smaller tour business owners, people especially in their first handful of years, sometimes as many as 4 or 5 years into the business. You're still not at a take-home pay that works for you. Or more typically, the way that we're running our business is we pay our vendors, we pay our guides, we pay all of our bills, and then whatever's left at the end of the year is kind of the scraps of what ultimately comes to us. Look, here's the harsh reality. If you don't build your own compensation into the pricing from day one, you can end up building a business that works for everyone except you. We can sell tours, activities, and experiences at a loss, and people will happily buy them. But we need to make sure that we have a tour and activity business that is working for you as the business owner. A great way to think about this is by pulling yourself out of the tour activity business. And if you had to hire for all of the roles that you yourself are doing, that's how we, knowing that we would have to pay somebody at the market rate to perform that task, gives you a true sense of the costs of operating that business. As an example, let's say you're the one leading some of your tours. Well, you need to separate your role as a guide from your role as the business owner. You want to pay yourself a reasonable guide rate for the tours you lead, plus then a management fee or marketing salary that reflects your various roles within the business. As one successful tour operator put it, the day I started paying myself first was the day my business actually started working. Mistake number 3, failing to build in distribution margins. Now, when we are setting our prices, it's very easy to overlook the cost of resellers or paying commission, from anyone to online travel agents to hotel concierges and wholesalers and other partners. Many operators set their pricing based off of direct sales, based off of factoring in, hey, I need to cover X amount of a marketing investment, which is going to drive direct sales. But the challenge then comes when we experiment with, or when we go to test and try other distribution and reselling channels, we find we simply can't afford it. There are tons and tons of comments online with operators who we empathize with, who are saying, hey, I simply can't afford to pay a 25 or 30% commission, when most of the time what this means is we haven't priced our tours properly. Not to say you have to work with online travel agents or any particular distribution channel, but it is smart to build in flexibility. And it is smart as a tour and activity business to not become overly reliant on any individual direct channel or any individual indirect channel. But to do this effectively, we have to price in those commission rates right from the start. For day tour operators, typical commission rates for online travel agents like Viator and Get Your Guide are anywhere from 20 to 30%. Hotel concierges between 10 and 20%, travel agents 10 to 15%, tour wholesalers 20 to 25%, and destination marketing organizations anywhere between 10 and 15%. So it's important to note that there could be a lot of geographical variation. We have some members in the coaching program who are down in Cancun who are paying as much as 50% commission to some of their local agents and resellers. In a place like San Francisco, hotel concierges may be looking for a commission as high as 25%, whereas up here in Vancouver, that might be as low as 10 or 12%. So as always, do your own research and reach out to some of those local agents and concierges to find out. Now you might be wondering, well, shouldn't I just have a 25% commission built on if I know that that's the highest commission rate and I want to sell through an online travel agent? Well, that's not a terrible idea. In later videos, we'll talk about something called a blended commission rate, where you essentially total up your direct sales and your different channels, and then you essentially figure out what is the overall commission rate that you're paying in the business. So for example, if 50% of your sales are direct and there's no commission, and 50% of your sales are 25% to a company like Viator, well, then we know that the blended rate is actually just 12.5%. So you can get into more sophisticated markups, but if you're interested in having the breathing room to be able to say to someone like Viator or Get Your Guide or other online travel agents and online distributors, hey, I will happily pay that 25% commission as long as you bring me the customer. So in part, it depends on your growth strategy, but let's build that in right from the beginning. Mistake number 4 is failing to track all business costs. This is when a lot of those small but often overlooked expenses can pile up and sometimes surprise us at the end of the year. Many tour operators cover and track the obvious things like guide fees, vendor fees, vehicle expenses, insurance, tickets from suppliers, etc. But we often overlook some critical operational expenses. For example, booking software fees, which are typically between 1% and 6% per booking, or perhaps you have a flat fee. It's essential that you track this. This isn't a fee that is simply passed on to your customers. This is an expense to you as a business, and we want to know what it is year in and year out. We have credit card processing fees, customer service expenses, website maintenance, software subscriptions, and even the depreciation of equipment. And of course, the real culprit here is so often the things that we as tour business owners are doing ourselves. If there is some admin task or customer service task or something that's taking you a few hours a week, we need to factor that in. We need to make sure that if we pulled you out of the business, we would have to hire somebody to do that. Tracking these costs not only helps you set proper pricing from the beginning, but it's also important for you to come in afterwards and look at ways that you can cut costs to increase profitability down the line. So for example, let's say you did $500,000 in direct sales and you were paying a 6% booking fee. Well, we know that that would be $30,000 in terms of a booking software expense. If you doubled your direct sales in a year or two, and now you're doing $1 million in sales, you've doubled the cost of your booking software as well. You're now paying $60,000 for that exact same software. This is where that cost creep is important to keep track of. Mistake number 5 is insufficient profit margins. There's a whole lot of tour operators out there that think they're running profitable tour and activity businesses, but once they account for all of their own inputs, they start to appreciate that you are running a business either just at break even or with minimal margins or potentially even at a loss. What we have to understand is that our profit margin should be separate from our take-home pay. That additional profit is not just nice to have, but it is essential for a thriving, profitable tour business. Without those healthy margins, we can't weather unexpected challenges like economic downturns or pandemic disruptions. We can't invest in new equipment or potentially new experiences. We'll struggle to hire additional staff to scale beyond ourselves. It might be difficult to take time off without your business income stopping. And a healthy profit margin is essential if you want to build a business that has value should you want to one day sell it. Or put another way, the value of your business is often your assets plus a 2 to 3x multiplier on your annual profits. Now, keep in mind, that's not your take-home pay profits. Or if you are paying yourself, let's say, out of dividends or capital gains, and that's the arrangement that you have with your bookkeeper and your accountant, that's one thing, but that's not what we're talking about here. We want to have a profit margin that is sacred on our tours, and it's built into our pricing and almost never sacrifice. Mistake number 6, using static pricing. What I mean by static pricing is simply charging the same amount year-round regardless of the conditions. Now, dynamic pricing and variable pricing is really common in the tourism sector. Think of the way that airline and hotel bookings are accommodated. Now, for the most part, tour and activity business owners should use structured variable pricing versus the more complex dynamic pricing, which is often based on changing the prices in real time based on the number of passengers left, booking trends, etc. that we sometimes see with airlines. How does static pricing hurt your profitability? Well, you're leaving money on the table during those high demand periods, meaning times when the supply, the number of seats or tickets that you have available is less than the total demand. 2, you're missing opportunities to attract price-sensitive customers during low demand periods. And 3, we're not optimizing capacity across the entire operating schedule. Even simple forms of variable pricing can significantly increase your annual revenue. Here are 3 simple ones to start with. Seasonal pricing, meaning charge more in peak season and lower in those shoulder or off seasons. 2, day of the week pricing. Typically, this is higher on weekends and lower midweek, but it could be any time where you have a surge in demand or you're typically selling out. And finally, time of day pricing. If you have higher demand at certain times of the day, like primetime slots or at sunset, then you can charge premium rates. One adventure tour company we worked with increased their annual revenue by 22% simply by implementing these 3 basic pricing tiers without any increase in operating costs. Mistake number 7 is not knowing your break-even point. Now, your break-even point is essentially on tour when the total revenue you generate from ticket sales covers all of the costs of running that tour. Notice that the break-even point is different than the trip minimum. Understanding break-even is essential, but trip minimums should be set above the break-even point to ensure sustainable profit. The trip minimum is simply the lowest number of guests needed for the tour to be worth running, ensuring that healthy profit margin. For example, if 4 guests break even, a tour operator might set a trip minimum at 6 guests to ensure a reasonable profit per departure. Setting a trip minimum too low can lead to barely covering costs, while setting it too high might result in unnecessary cancellations. This matters for our pricing strategy because it allows us to set smart minimum group sizes. It allows us to understand when we should cancel and obviously adjust our pricing strategically. Now, there might be times, and it might be entirely appropriate choice to make, to run a trip at a break-even point or below your trip minimum, especially if there is a new product or service, or perhaps there's opportunity for additional revenue or a partnership coming down the line, but we want this to be the exception rather than the rule. Mistake number 8, undervaluing your unique experience. Most tour operators position themselves as comparable to others, or we focus too much on what others are offering instead of identifying, articulating, and communicating the real world tangible value that we are providing to our guests, our clients, and our customers. Ask yourself, what access do you provide that others don't? Is there expertise or access that your guides and staff bring that's truly unique? What moments in your tour cannot be experienced elsewhere? Who are you uniquely positioned to serve? The tour businesses that command the highest prices aren't necessarily those with the lowest costs or the fanciest equipment. They're the ones that create truly distinctive experiences and can communicate that value clearly on their sales pages and marketing materials. Put another way, your pricing should reflect the true value of what you're offering, not just the cost of providing it. All right, let's quickly recap those 8 mistakes. 1, simply copying competitor pricing. 2, not paying ourselves first. 3, failing to build in distribution margins right from the start. 4, failing to track all business costs. 5, insufficient profit margins. 6, only using static pricing. 7, not knowing your break even and trip minimum points. And 8, undervaluing your unique experience. Being aware of these pitfalls is a first step towards pricing profitably. Now, in the upcoming videos, we are going to get even more granular, so don't go anywhere. If you'd like to grab our ultimate tour pricing calculator, you can use the link below and find it at guestfocus.com/pricing. This is a gift from myself and the coaching team to you to help you on your profitable pricing journey. If you're watching this here on YouTube, make sure you hit subscribe, turn on that notification bell to be notified when the next video comes through. And if you want to share this with a friend or colleague, it would mean the world to us. Thanks so much, and we'll see you in the next video.